Well, by now you've probably heard the news, how the Fed lowered the federal funds rate by about 50 basis points or 0.5%. Yay! But did you know that mortgage interest rates actually went up slightly? Yeah, wait, what? How does that work? Well, that's what we're covering in today's video. First, what's the difference between the federal funds rate and mortgage interest rates? And then how will that affect you if you're thinking about moving forward this fall or winter and buying a home for yourself? You know, this fall and winter is going to be the best time to buy since about 2012. So let's get started so I can tell you why. First, what is the federal funds rate? Well, the federal funds rate is the interest rate that banks charge each other when they lend money overnight. You know, banks borrow money from one another to meet their daily needs, like having enough money in their accounts. And the rate is set by the Federal Reserve. That would be Powell and his group, who we've been discussing all year long. And it helps control how much it costs everyone to borrow money, like when people get a car or a credit card. When the federal funds rate goes up, borrowing money becomes more expensive, and when it goes down, borrowing money gets cheaper. So we tend to say they go in tandem with each other, but it's not an automatic effect, like what happened last week. When Powell lowered the federal funds rate by 0.5%, everyone got excited, thinking interest rates were going to come down, right? I know my sellers got excited. They were thinking, this is great. If the Fed's funds rate lowered, more buyers are going to come to my home and they'll want to bid on my house. Well, I checked with my lender and I found out that the rates had actually gone up slightly. Well, how did that happen? Yep. The mortgage rates actually increased slightly, and that's because the federal funds rate only directly affects short-term interest rates like those for credit cards and other certain types of loans. You know, mortgage rates or mortgage interest rates, on the other hand, are influenced by broader market factors, including inflation expectations. If inflation is expected to rise, then lenders will increase mortgage rates to ensure they're compensated for the decreased purchasing power. Then there's the supply and demand for mortgages and housing market conditions, which can push rates up or down depending on the Fed's actions. And then the bond market trends. You know, mortgage rates often follow the yields of long-term bonds like the 10-year Treasury. If bond yields rise, mortgage rates may increase, even if the federal funds rate is lowered. So while the Fed's rate cut aims to make borrowing cheaper, other economic factors can still cause mortgage rates to move in the opposite direction. The good news is we're a full % down from where we were in September of 2023. So buying power for buyers has definitely increased. And as we enter the fall, this is usually a great time to be talking to home sellers and negotiating, whether it's a lower price or a seller concession for buying down the rate, or even help with closing costs. This is usually a great time to be doing that, and here's why. New listings are up 4.4%, leading us into almost 12 weeks of inventory. That means we have almost a 3-month supply of homes for sale in the market. Now, remember when I did some of those market update videos about a year and a half ago? I was reporting that we had mere weeks on the market, usually like 2 or 3 supply of homes for sale. Well, now we have 3 months inventory. That means a lot more choices for buyers, which means as a buyer, you have sellers out there that might be willing to negotiate with you because they've got a lot more competition than they've had in the last year or even year and a half. Along with the increase in inventory, we've also seen an increase in days in the market. This has almost doubled from last year, and the median days in market currently is hovering around 22 days, though, to be honest with you, when I look at some of the neighborhoods that I serve, I've seen much longer than that, approaching almost 60 days in some cases of homes in the market before offers are being received. And this is reflective of the higher home prices, the higher interest rates from a few years ago, and much more inventory that the buyer has to choose from than they've had in the past. Listings closed are down 5.7%, even though mortgage interest rates have been trending down since June. And as I film this, they're now sitting in the low 6s, definitely much, much better than the over 7% we were dealing with earlier this year. But slowing home sales may be because median prices are still climbing. Yeah, they're up 1.6% year over year. Currently, the median price is hovering around $589,000, up from $580,000 of August of 2023. But I know the real question on everyone's lips is, will the Fed drop the rates further, or better yet, will mortgage interest rates drop further? See, the Fed did cut the Fed funds rate by about 0.5% to 4.875, but they put out a policy statement that talked about how the economy continues to expand at a solid pace, how job gains have slowed, even though the unemployment rate has moved up, it remains low, and how inflation has made further progress toward toward the committee's goal of 2%, but it still remains a bit elevated. The committee seems to be gaining confidence that inflation is moving in the right direction toward that 2% goal. However, they're still being dovish when it comes to guaranteeing any further rate drops this year. Moving forward into the fall and winter months, I bet the committee is going to be carefully assessing incoming data, the evolving outlook, and balancing the risks. And once again, in their famous dot plot map, which all 19 members of the committee voted anonymously, was the projection for dropping the federal funds rate over 1%, but next year. So, however, we can't get too excited about this because remember I did a bunch of predictions last December where we're supposed to get 3 federal funds rate decreases throughout this year. That didn't happen. And even looking forward, if the Fed does drop the federal funds rate to maybe 3.5%, long-term treasuries like 10-year, 20-year, and 30-year yields won't drop that much, and more importantly, neither will mortgage rates. Why? Well, because the federal funds rate is an overnight lending rate between the banks set by the Federal Reserve. So if a bank can earn 3.5% overnight by lending to another bank, why would they purchase a 10-year treasury note at the same or lower yield? They won't do that. Not unless our economy is in a recession or headed towards a recession with higher unemployment and lower inflation figures. Think of the federal funds rate as a tool the government uses to control how expensive borrowing money is for short periods of time. But it doesn't have a big effect on long-term loans like fixed-rate mortgages. Mortgage rates change based on things that are happening right now in the economy, like inflation and unemployment, rather than just what the government does with its rate. Though sometimes they'll follow each other, it's just not a guarantee. For mortgage rates to really drop, inflation needs to go down, and unemployment needs to go up a bit more from that 4.1% where it currently is, which, by the way, was the target number for the Fed's rate drop back in December of 2023. So mortgage rates will really be dependent on inflation numbers, especially the core PCE, and unemployment rate, and the labor market. For now, don't worry too much about the Federal Reserve's rate changes. Instead, focus on today's mortgage rates, which could be the best we'll see for a while. A lot of people wonder, should I buy a home now or should I wait? I'm a big believer in buying property in the fall and winter, and I've mentioned that in previous videos. This is the time of year, the best time of year to buy a home because of the seriousness of the sellers that are on the market. This is when I buy, and it's the best time of year to find the better deal. Add to that the fact that we continue to see home prices rising. Yeah, even with our interest rates over 7% earlier this year, we still saw home prices rising month over month and year over year, and they are projected to continue to rise over the next 5 years. Rising home prices just don't sound so good right now. But if you own a home, that growth will be a big bonus for you. Keeping Current Matters reports that if you purchased a median-priced home back in January of 2024, you have the potential for $90,000 in home equity gain over the next 5 years. So unless you've got some great investment that are bringing you more than that, this might be the time to start having some of those serious conversations with your trusted realtor, with your lender, or reach out to us and start talking about whether or not now is the right time for you to get into home ownership. Waiting on the Fed could mean missing your chance. Hi, my name's Peggy Durstoff, a realtor with Live Denver Suburbs, powered by HomeSmart. And if you enjoyed this video, check out this one over here where I talk about the pros and cons of living in a townhome community, and I even show you a townhome currently on the market. It might help you with your home search. Thank you so much for watching, and I'll see you on the next video.